We are in the house of the Financial Accounting Standards Board, FASB. We will discuss the lease agreement from the lessee's perspective to prepare for this accounting standard exposure draft. Let's start with the definition of the lease agreement. A lease is a long-term contract in which the owner of the property or the lessor allows another party or the lessee to use the property for a stated period in exchange for a stated payment. Are there any issues regarding the classification of a lease agreement by the lessee? The primary issue is whether the lease agreement transfers substantially all the benefits and the risks of ownership of the leased asset to the lessee. Based upon the answer of this question, a lease can be classified as a finance lease or as an operating lease. Have we set a lease classification criteria in this accounting standard to differentiate between a finance lease and an operating lease? Yes. A lease is classified as a finance lease by the lessee if, at the lease commencement, at least one of 5 classification criteria is met. What these 5 classification criteria are? Well, these are as follows. 1. The lease transfers ownership of the leased asset to the lessee by the end of the lease term. 2. The lease includes an option to purchase the leased asset that the lessee is reasonably certain to exercise. 3. The lease term is for the major part of the remaining economic life of the leased asset. In this regard, a lease term of 75% or more of the remaining economic life of the leased asset generally is considered to be a major part of its remaining economic life. However, this criterion is inapplicable if the beginning of the lease term is at or near the end of the economic life of the leased asset. This period generally is considered to be the last 25% of the leased asset's total economic life. We still need to know the classification criteria numbers 4 and 5. Classification criteria number 4, the present value of the sum of A lease payments plus B, any residual value guaranteed by lessee equals or exceeds substantially all the fair value of the leased asset. In this regard, a present value of 90% of the fair value of the leased asset generally is considered to be substantially all of its fair value. Before we go to classification criteria number 5, could you please define what is the residual value guaranteed by lessor considered when calculating the present value of future lease payments? And also, what is the unguaranteed residual value? The guaranteed residual value is a promise made by the lessee that the lessor can sell the leased asset at the end of the lease term for a guaranteed amount. Since this promise is a potential future payment, it must be included in the calculation of the present value of the lessee's future lease payments. However, the unguaranteed residual value is the expected value of the leased asset at the end of the lease term in excess of the guaranteed residual value. Okay. Please continue with the classification criteria number 5. Classification criteria number 5. The leased asset is so specialized that it is expected to have no alternative use to the lessor at the end of the lease term. What if none of the 5 classification criteria described above are met? When none of the 5 classification criteria described above are met, the lease is classified as an operating lease by the lessee. How does the standard define a short-term lease? And how does the accounting policy treat it? Short-term lease is a lease that, at commencement date, 1. Has a lease term of 12 months or less, and 2. Does not include the purchase option that the lessee is reasonably certain to exercise. As to the accounting policy for short-term leases, a lessee may elect not to recognize the right of use and lease liability. Under this short-term lease exception, lessee recognizes lease payments as rent expense on straight-line basis over the full lease term. Is the short-term lease a form of off-balance sheet financing? Yes, it is. The lessee has the right to use the leased asset, but neither the asset nor liability for future lease payments is recorded in its financial statements. Lessees may prefer to account for a lease as a short-term lease instead of as a finance lease to avoid recognition in the financial statements of 1. A liability for future lease payments, 2. Interest expense, and 3. Amortization of right of use of the leased asset. Are there differences between U.S. GAAP and IFRS in the classification of leases? The differences are, under IFRS, 1. An operating lease is not a classification option to the lessee. Lessee accounts for all leases, except for short-term lease and low-value leases, similarly to a finance lease under U.S. GAAP. 2. The lessee may elect to account for a lease of low value, which are assets with a value of $5,000 or less, the same way as for short-term leases. The lessee then recognizes lease payments as an expense on a straight-line basis over the lease term. The session is up. We will continue discussing this accounting standard in the coming sessions. Thank you.